Is history going to repeat itself just like the 2000.com bubble? And the AI bubble right now, it is doing exactly what caused the dot-com crash. And I'll show you 5 indicators that prove this similarity. And when you look at the last one, you're gonna be like, not again. So let's get into it. Now, the first obvious sign is the parabolic increase in the price chart. Now, why does this happen? Because the expectations of investors on these tech companies back then was so high that they were willing to pay an expensive price to own these stocks, even though the P ratio were at sky high levels, price to sales ratio at sky high levels. When greed comes in, you realize a lot of times P ratio would go out the window. People would not care about P ratio because even if I pay a high price, there's a greater fool out there who is willing to pay a higher price than me, and hence the price is going to go up. So you can see that prices are high, they would go higher, and very few retracements, except for what happened earlier this year. And if you look at the price action right now, you realize that seldom does the price action go back to the mean, meaning the average. So if you understand from my tutorials on how moving averages really work, when the price goes too far beyond the moving average, it has to come down eventually to the mean, to the average, before it goes back up again. It's just how the markets work. And if you understand chart patterns, you see a reversal chart pattern too. Then it started to crash. Now the next similarity is price to sales ratio. And as you already know, Nvidia is one of the top stocks and is also one of the magnificent 7 AI stocks. Okay. And tons of greedy investors are snatching up Nvidia, even though the price to sales ratio, it is overvalued. P ratio, it is overvalued. Now, to put in simple terms, what is price to sales ratio? Basically, it tells you how much are investors willing to pay for each dollar of sales generated by the company. As of the making of this video, it is at 26.1. So back in 2000, then, what is the equivalent of Nvidia? Like everybody was snatching up this tech stock, which is Cisco. Now, when you look at the Cisco price to sales ratio chart, you can't see it here, but in the 2000 pre-crash levels, it went all the way up to 38.9. And why do I compare price to sales ratio as compared to PE ratio? Because PE ratio, it involves earnings. And earnings, if you understand financial statements, they can be manipulated. And there's a lot of creative accounting going on with depreciation and amortization, as well as recurring, non-recurring items. Non-cash items could also affect the net income. So price to sales ratio is a more fair comparison as compared to PE ratio. Now, the next similarity is index concentration. Now, back in the 2000.com bubble, there was select few stocks that people just keep talking about. And there's even a name for it. The top 7 stocks back then: Cisco, Microsoft, Intel, Amazon, Yahoo, Qualcomm, never heard of that company by the way, eBay. .com darlings, 7 stocks. Is this some form of K-pop group? Then right now, Magnificent 7. Wow, the name is even nicer now. By the way, if you want me to analyze each of these stocks, let me know and stay tuned for it. Subscribe if you don't want to miss out on these. But what do I mean by index concentration? Now, if you go to this website called slickcharts.com, you can see at this point in time which are the companies that take up majority of the components of the S&P 500, okay, because it changes. And if you see the top 10 stocks being dominated by this one sector, you know. When you know, you know. You see, okay, number 1, for sure, Nvidia, Microsoft, Apple, Amazon, Meta Platforms. And this is in descending order based on percentage weight: Broadcom, Alphabet, Tesla, Warren Buffett's company, JP Morgan Chase, Oracle. And same thing back then, the tech stocks that I showed just now, they took up as much as 40% of the index. So when you see capital money crowded into these few names, that would become a risky trading environment. And everyone knows, okay, the stock market is going up because of the AI trend. But there's this behavior finance term that a lot of people don't know about. It's called sectoral contagion effect. Now, to put in simple terms, Let me tell you a story about this. Because this company called Tata Steel is one of India's most famous steel companies. At one point in time, Tata Steel posted, wow, amazing quarterly profits. But the rest of the steel companies in the same industry, mediocre performance, but still went up. Why is that? Because Tata Steel is making good money, means that steel industry must be doing so well. So let me buy all the steel companies too. And as a result, a lot of the competitors of Tata Steel went up. Profits didn't increase, but their stock went up because of this kind of irrational behavior. How one company could produce a ripple effect and then cause the whole industry to go up. Now, the next similarity, same thing, retail participation. Now, I'm not just talking about, okay, traders who have been trading for a long time, investors who've been around the markets for a long time. The moment you see non-traders jumping in with real money, talking about stocks, recommending stocks, you know. But of course, a more accurate way of measuring this, you can look at a lot of indicators, one of which is fear and greed index. I've mentioned a few in the past few videos too. And what are their favorites? Not surprising, right? Individual investors have been on a record setting buying streak. They are loving the Magnificent Seven. Now, you go to Facebook, Instagram, TikTok, it's like everybody is making money, even though they are not traders, like influencers who are not even traders, investors. Suddenly, they are talking about stocks, talking about gold, financial markets. Then you know. And I've been doing some research as to which kind of influencer are making money. You'll be surprised. And how many hours do they study a week? 2 hours. Good for you. And if you study behavioral finance, you know that a bubble can only be formed when there are enough greedy investors. Not rational investors, enough greedy investors. So as of the making of this video, okay, and this is my guideline, less than 20 shows you that investors, they are complacent. When it goes to 20 to 39, they are fearful. More than 39, panic. Okay? So when everything, all hell breaks loose, this thing is going to spike up. To know whether you are truly a competent investor and trader, if you can last more than 3 years, you are the real deal. If you're here only during a bubble, making money during a bubble, losing everything afterwards, you are just here for speculation. Now, this next factor, you'll be surprised as to why people do this. So let's not blame investors entirely, because companies and media also play a role. What happened in the dot-com bubble back then was that companies who were not in the tech industry and they wanted their stocks to go up, what do? Not change to a new business. They just add one word to it, .com. Then their price went up. Right now, companies are changing their names or adding the word AI to their project, to their company. Even if they don't earn more as a result of that, their stock price went up. Because investors, the moment they see, oh, you're taking advantage of AI, must be good, let me buy. But how do you know whether a market crash is going to come? I'll put the tutorial somewhere on this screen. Subscribe if you don't want to miss out on future market analysis and stock analysis. I'll talk to you in the next video. Bye.